I'm Mary Owens with Owens Estate and Wealth Strategies Group. Welcome to our Fall 2018 Economic Update. We're going to start with a real estate update. With so many of you right now keeping your eyes on this subject, we thought this one would be very timely to give you some relevant information on where the real estate in the United States is going at the moment. Now, the very first slide I'd like you to take a look at is a little tough to look at, but the light blue line are new U.S. home sales. The black line are existing home sales. Now, normally these two are fairly well coordinated together. So the correlation is fairly close to 1. But you'll notice after the financial crisis, these two began to diverge significantly. This is part of the reason right now of the real estate bubble or potential bubble we're having, because new U.S. home sales are falling behind. So we're going to show you a little later what's causing that, but keep this slide in mind because it's going to be a really important point we're going to circle back to. The next slide is the U.S. ownership rate. Now, right now, we're beginning to finally see some increase after U.S. home ownership fell off the cliff during the financial crisis. Right now, U.S. home ownership is approximately 64% in the United States. I do believe this number will continue to rise in the future as long as we can solve the problem of building new homes in the future. Without it, however, this area may stabilize or actually regress. Now, the first problem we have to look at to understand what's going on in the United States real estate is to look at U.S. structures built by decade. Now, you'll notice on this slide, we were building approximately 14 to 15 million structures per year for most decades into the past. 1940 and 1949, of course, were substantially lower. We were climbing out of the Great Depression, but also the population was less than half of what we have today. But also, please note, we have built between the time of 2010 through the period at the end of 2016 less homes than we did in 1940 to 1949. Based on population, we should have built over 20 million structures by now. This is part of the problem. So what's causing this deficit in building? We have to look at some of the issues that we experienced after the Great Recession. We passed a bill called Dodd-Frank. Dodd-Frank put a variety of banking restrictions on that has made it very, very difficult for regional and local home developers to be able to get financing. This is having a direct impact on the U.S. structures being built this decade. It also affects commercial real estate, but to a lesser degree. So the vast preponderance of the shortages of homes that have been built this decade, or I should say structures that have been built this decade, are all related to single-family residences. So let's look at a picture of what the demand for single-family residences are going to look like now and into the future. So we have a generation chart up there. But what I want to point out is millennials started the traditional household formation late in their life because of the Great Recession. Now, household formation is when a young family or individual decides to leave their home of their parents or those who raised them and set out on their own and create their own living abode or buy a house. Now, why is this household formation so important to the economy? Well, first off, it does encourage home building. And without home building, we have rising home prices. But the second thing that household formation does is very positive to the economy overall. When you start to form a house, think about your expenditures. You go out and buy dishes and furniture and drapes and appliances and garden furniture and on and on. You basically walk into Target or Walmart and you buy almost virtually one of everything. So we have a chart up there right now that says our U.S. home inventories right now is a little under 2 million. But you notice this chart goes clear back to 1999, and we have inventory that's less than we did in 1999, when the population was only around 279 million, and it's over 380 million today. So how much inventory should we really have to be able to address a normal inventory level for not only the population, but the number of people entering household formation? It should be closer to about 2.75 million to 3 million. So we have a lot of homes we still need to build. Now, without building enough homes, what happens to the U.S. median house price? Well, of course it goes up, and it goes up substantially. So our U.S. median house price right now is higher than it was in the bubble in 2006. Now, it doesn't mean the house prices per se is in a bubble, but what it does show with the increasing demand because of all the young people entering household formation, we don't have enough inventory, and that problem is causing median home prices to go up. So if we look at U.S. housing starts, this gives us a clue of how big the problem is. In the United States right now, we're just under 1.3 housing starts a year. What is the average in the United States? It's about 1.4. But that average was not created with population adjusted. So if we really want to address how much housing starts we should have right now to be able to keep the median housing price closer to normal with a normal rate of annual inflation, we need to be building over 2 million homes a year. These are all the things contributing to the increasing U.S. median house price. So a lot of people have indicated these generations that we're talking about right now can't afford a home because they have too much debt. And if you look at this slide, you'll see that that's not true. The household debt service ratio right now is less than 10%. It's lower than it's been in actually decades. So when we look at a household debt service ratio, yes, there are people out there that have some student debt, but that's not what's causing them to not buy a home. The biggest issue in buying a home right now is a lack of availability and a lack of affordability because we're not buying enough homes and the U.S. median price house is going up too quickly. So let's briefly move on to some other major economic indicators. We've got a lot of questions right now about the United States going into a recession. They said we're in one of the longest economic expansions we've ever had. Well, if you look at leading economic indicators, what are these? These are indicators in the economy that tell us about future economic activity. They're growing, and they're growing substantially. So there is not any signs yet in leading economic indicators that we're close to a recession. Now, there are other ways to evaluate this as well. We usually have a great number of indicators that start to turn to caution lights when a recession is nearing. If you look on this chart right now, you'll see that we have only one yellow caution light in all the indicators, and that's called profit margin. And why is profit margin stretched right now? Because we have such high employment. For the first time, we're beginning to actually see wage growth. And at the same time, we have trained consumers to buy on sale. So companies have learned if they want to sell their products, they have to sell it with less margin. So right now, when I look at this, there is no imminent sign of a recession in the United States based on traditional measurement standards. So let's briefly jump into some world economics. How is the United States doing relative to other countries? Well, first, let's take a look at the United States international unemployment versus ours. Right now, the U.S. unemployment rate is at an extreme low of 3.7%. Now, if you look at this slide, most countries are significantly higher than we are. We are very, very blessed with our low unemployment rate right now, and that is helping drive the economy. But if we also look at the United States gross domestic product, we also have some areas that are stellarly good. Now, U.S. GDP is made up of several different attributes: spending, domestic investment, exports, government spending, imports, which can be a negative, totalize the total GDP that we measure. In this last particular quarter, we had no area of the economy that was actually drawing down on the GDP. We haven't had that in a long, long time. So what was leading our GDP rise? Mostly, actually, spending in the United States. There's a sign of household formation. People are buying a lot of things as they're moving into houses. But the other thing for the first time that's rising significantly are U.S. exports. This is helping us as well. Now, government spending is up, but if you analyze the budget, a great amount of that is interest expense. And this probably will continue because as interest rates go up, so will the U.S. spend more money on the debt that it has, which, as we all know, is very significant. So if we look at the euro area GDP growth rate, ours is 4.2, theirs is 0.4, a very small rate. Actually, the euro area is weakening, and they had better do things to structurally change some of their economic issues, especially in the banking sector, or this will continue. If you look at China for all its smoke and mirrors, talking about how it's going to grow just into oblivion and be the fastest grower in the world, actually their GDP rate right now has slowed down to 1.8%. So it's very different than what we've had before. Yes, China is growing, but it's now growing more like a developed nation instead of an emerging market. The growth rate in China in the future probably will remain much more calm than it has been in the past. So thank you for your attention. This is our update for fall of 2018 on world economics.